Hello and welcome to the latest in our series of webinars brought to you by Growing Business Intelligence. I'm the editor of Growing Business Intelligence, Rachel Bridge. I'm absolutely delighted that you can join us today. In this webinar, we'll be looking at the funding models which are available for growing businesses to access and talking about what would be perhaps the best sort of funding model for your business in order to take it to the next level. It's an astonishing fact that actually many business founders simply don't think beyond traditional forms of finance, such as bank loans, which means they often abandon the hunt for funds if banks decline to help. In fact, 50% of small businesses give up when traditional lenders can't help them. But in fact, there's a whole world of other options out there to fund your business. And the aim in this webinar is to have a look at all those different types of finance and to see the whole range from the traditional to the alternative. Please do feel free to ask questions or make comments at any point using the Q&A function on your screen. I'm joined today by Dr. Valeria Vitkova, a research fellow at the Business School at City, the University of London, and Matt Ovenden, the founder of borrowaboat.com, a boat rental business, which is quite literally in the process of raising money through crowdfunding. In fact, when I last looked, I see, Matt, that you've already far exceeded your funding target, and your campaign still has a few days left to run. So many congratulations. We look forward to hearing a little bit about how you did that shortly. First, though, I'd like to kick off by asking Dr. Vitkova, Valeria, to tell us a little bit about what types of funding are currently available to help businesses grow. We know all about bank loans, but what else should businesses which are growing be considering?
So I like the statistic that you mentioned as well, because it really points to the fact that there is a knowledge gap out there really in terms of what the options that are available are, and there is a funding gap as well. So obtaining the funding that you need to grow is crucial. So according to the British Business Bank, for example, SMEs who obtain external financing are between 15 to 25% more likely to become high growth firms. So what are the available options? Well, you should seriously consider alternative lenders who are often more accommodating and can be more willing to lend to SMEs. They may take on more risk and they may be more willing to work harder to find flexible solutions. Within that, peer-to-peer lending, which you can really think of as debt-based crowdfunding, is one key option. So that's where individual investors provide business loans, and it's usually faster and easier way to secure finance than a bank loan. So peer-to-peer loans are normally...
Or is it we've lost everybody? Are you back with us? Yes.
Yeah, can you hear me?
I can. Maybe it was me that lost everybody.
Yeah. So with peer-to-peer lending, this is where individual investors provide businesses with loans, and it's usually faster and easier. These are normally secured through online platforms. So for example, if you're a qualifying startup, you can be given access to unsecured business loans of up to £500,000. Funding Circle, Zopa, and RateSetter are examples of online peer-to-peer lenders. To give you some stats on this market, according to a recent report by the Bank of England, the UK has the largest alternative lending market in Europe, and growth in lending to SMEs is mainly driven by P2P, peer-to-peer lending, and smaller banks. So this accounts for approximately 10% of lending to SMEs. In the context of alternative lending, I think you should also consider approaching challenger banks, which are basically recent entrants of the lending market, and they specialize in SME funding. They can be more flexible and accommodating than traditional banks. Examples are Metro Bank, Atom Bank, Virgin Money, and Monzo Bank. On the equity side, apart from the traditional family and friends option, Crowdfunding in the UK has experienced one of the fastest growths. So this market grew by 31% in the year through to February 2020, and it accounts for 3% of the overall SME funding market in the UK. There are two types of crowdfunding that we should distinguish between. So there's consumer focused, which is appropriate if your business is product based. So you don't need to give up any equity. Crowdfunding through platforms like Kickstarter and Indiegogo offer way to ensure some guaranteed pre-sales before you even start manufacturing. With this option, one key point to consider is making sure that your pricing structure accounts for all the possible hidden costs of producing and distributing your products. Then there is also the investor-focused crowdfunding, where you've got platforms such as Crowdcube and Cedar, which allow you to raise cash by turning your supporters into shareholders. This is great for startups with a business that isn't product-based. With crowdfunding, you can basically search for and invest in businesses that really resonate with your interests and beliefs. And one effect of that is that the providers of the funding may be willing to accept lower returns. You should also consider approaching perhaps business angels and venture capital funds. These provide funding in exchange for an equity stake in your business. An angel investor, the way we define that, is a high net worth individual with net worth of £1 million or more. They typically tend to invest between 25 to 100,000 pounds in your business. They're often interested in investing in businesses that already have at least a product prototype developed rather than just an idea. They can be useful because of their business knowledge and contacts. Venture capital is also an option, and they operate in methods similar to angels, but would typically invest in later stage than angel investors. And the size of the investment counts as well. So, for example, the average investment with angels will be £7 million or more. And so the amount of funding here is a determining factor. What is important to stress is that funding is available. For example, according to a report released recently by PwC, venture capital deals in Europe totaled 10.6 billion euros in Q3 2020. So that's one of the strongest quarters on record. So just because of the fact that we're in this pandemic situation, you shouldn't think that funding is not available. Funding is available out there.
Thank you, Valeria. Let's just bring in Matt now, and perhaps you could tell us a little bit, Matt, about your own experiences in crowdfunding, perhaps starting with what your business does and why you decided to choose crowdfunding as a way of funding a business.
Sure. Yeah. Hi, everyone. Sure. So, yeah, my business is Borrow a Boat, as you can see up here behind me. We're often called the Airbnb of boats. So we're a boat charter marketplace currently with 35,000 boats worldwide for charter. And yes, we've used crowdfunding quite a bit in the last few years since I founded it about 4 years ago. We're actually live on Cedars right now for anyone interested who wants to have a look. We're live on the platform over 100% and still taking investment. Yeah, we're at the beginning of the journey. And so Valerie's mentioned a few there, such as startup loans and peer-to-peer lending. But at the beginning of a startup journey, I'd say they weren't really options for us because Funding Circle, for example, and lenders like those guys require you to be at least 2 years old to consider lending debt to you. So once you've started, if you imagine you've started a business in the last 6 months, you haven't really got a realistic chance of getting debt, I wouldn't say. That people want to see usually 2 years worth of accounts and trading. They want to see monthly recurring revenue. They want to see some sort of stability. You also may not want to take on debt because of the risk to you personally. If you mind personally guaranteeing it and something in the business for whatever reason may not get to where you want it to get to, and you may be saddled with this debt on your own shoulders, which is a very very uncomfortable for any entrepreneur founder. So for debt wasn't really an option, I have to say. So at the beginning, you're looking at, you put some funds in to start. How to get going. I mean, it's too early for a VC as well. You can't get a VC investor for a while. You need at least, again, probably 2 years trading ideally. I mean, you're a particular sort of business, maybe a year's worth. So that's the gap you've got to bridge. You know, you can't really get debt and you can't really get a VC. How do you do it in between? And angel investors obviously fit well into that space. And I see these crowdfunding platforms as a way to access angel investors, basically, as well as wider sort of more retail investors, which is the Crowdcube Seeders unlock. So most startups will begin with typically a friends and family round at the very beginning, because if you put your own money in first of all, get as far as you can with that. Usually, get a minimum viable product built, get initial demonstration of the business model out there, get trading, get into the market as soon as possible, so that you can show something. But the first people you're going to invite to back you are going to basically be going on very little. They can't really see trading. They can't see a lot about the business. So they have to invest in you as an individual. And the best people to do that are people who know you. So that's why the best advice at the very beginning is to friends and family round. Go to your network of friends, tell them what you're doing, be honest, let them know there's a real risk involved, but that you think it will work, and here's why. And often you can often raise a certain amount of capital from your close people who know you, enough to get you through the next stage of growth, whatever that might be, building out a website or doing some marketing and demonstrating some more sales. And I would say that has to come before you really engage angel investors. I mean, you can engage angel investors, but they might wonder why you haven't gone to your own network first, if you haven't. And then the key is to get as much traction as possible. As I say, get in the market, get demonstrating some of the key aspects of the business, even if it's on a small number of markets or units sold, but just demonstrate the margins, and that you've got something that people want. And then I think when you've got a bit of traction, and you do need traction, then you realistically can pull in angel investors and then wider crowd and retail investors. And the route we went down was we used first a more of a niche angel platform called Angel's Den, which is only certain angel investors who will invest a bit more, typically 5 or 10k a minimum investment probably from these guys, and they're very sort of vetted investors, and the businesses are all vetted, and it's sort of like a matchmaking process we took part in speed pitching events and things like that, and then we ended up with a form of crowdfunding on their very closed platform. You have to be signed up to Angel's Den to see it. It wasn't such a public crowdfunding round as other platforms, but that raised us a certain amount. That worked quite well. I think we raised something like 80,000 or something from that in the fairly early days. But for me, when we were looking to raise again, say we're a year in, we're still too early for debt. We're still too early for peer-to-peer lending. In reality, as a startup, it's just not practical. It's still too early for a VC. But then we felt we'd exhausted a few angel channels, but you needed significantly more capital for the tech investment, for the marketing and growth. So this is where Crowdcube and Seeders fit well, just purely from the strength of their network and the size of their networks. I mean, Crowdcube, I think, is the biggest equity crowdfunding platform in the world. There's over 1 million investors on the site.
Matt, I think
Yes.
that's really interesting. And also, can you just tell us a little bit? You go on Seeders and crowdfunding, and there's loads of businesses looking and projects looking for investment. And I don't know the statistics, but a lot of them are not going to get the money they want. And how have you've done this 4 times now effectively? These raising money through crowdfunding and the initial angel one. How have you made made your business stand out so that people notice it? What have you done? Is it the type of business you're doing, or is it the way you're promoting yourself? What's the secrets there of success?
Yeah, we've done Crowdcube 3 times, all successfully. I think we were over 200% the first 2 times, and about the third time the pandemic arrived partway through the crowdfunding, but we still were cleared 100%. And then we're now on Seeders for the first time. There are quite a few businesses on there. There is a degree of vetting. There's a due diligence process that Crowdcube and Seeders apply to businesses. They don't just let any business on there with any offering. So generally, I think a lot of people do quite well, usually because if it wasn't a well thought out campaign, and they wouldn't let it go ahead, if that makes sense. But having said that, there is a technique to crowdfunding. There's a whole way to go about it, and it involves your network, your immediate network, your wider network, engaging people early before you go live with the plan. You need to pre-charge the round to a certain extent. You need to have lead investment, so you need a certain amount already in the can, if you like, before you go live. And it's actually changed, I think, in the last 3 or 4 years. And 3 years ago, most businesses were going live about 20 or 30% funded, and that was the norm. And then the crowd will start picking things up. I mean, anyone who thinks that you just sit back though and the crowds just give you money, it doesn't quite work like that. You've got to have a whole campaign plan. You've got to work that campaign for a month, and it will take up a lot of your time. You've got to outreach constantly, do events constantly, do pitch events, do investor meetings, do calls constantly to keep it going, in my experience. And the crowd do help, but the bigger investors will want to talk to you, and you will need to spend time meeting,
and Matt,
answering questions.
And Matt, we've got one of the comments here from Sabine, who's listening in, and actually Toby, who said he's already invested in your business. So that's fantastic. You've already got you're already selling to an enthusiastic crowd here. But Sabine's saying, you can't get VC till you've had revenue and traded for 2 years. So the way to go is get angel investors through crowdfunding. But crowdfunding, you need to have a certain amount of investment. So can you talk me through? So you actually started with angel investing before crowdfunding, but actually I think sometimes the crowdfunding brings the angel investing. How did you balance that and know what you were doing in terms of who you went to first?
Well, as I was saying at the very beginning, you kind of, the question there, how do you really start? The first group to go to is your friends and family, I would say, after your own initial ones, people who know you, because you're expecting people to back you on very little, really. You may have an idea and that's it, and a little bit of a website or trading, and for most investors that's not enough. So people are going to just look at you, and they have to invest in you. And so the people who know you are best to do that, as I was saying. And angels as well who come in will typically very much be judging the individual. They'll be looking at this person. Do I believe this person? Do I trust them? Are they going to do what they say they're going to do? Have they got the right experience on their CV? Are they, have they got the skills in this area? Do they know their market? Have they done enough research? Are they credible? It's almost like a job interview, speaking to investors at that stage. It's more that trust, getting them to believe that you're going to do the job, rather than showing what you've done and that you've got a business here, because at the start it's more like that.
That's interesting.
So I mean, niche investors, engaging niche angels and people who know you, or getting recommendations from people who know you to other investors. It's very much better to do it like that before you go out to a wider crowd. When you go out to a wider crowd, you need to have a bit more to show. You don't see businesses going on Crowdcube and Seeders that are just ideas. They've usually at least a year old, typically, and they've traded for.
Let's have a look at this whole question of equity, and I want to bring in Valeria into this one. So Matt, presumably by doing this angel investing crowdfunding, you've given away a fair chunk of equity in the business. Is that right? Can you talk me through how much you've given, if you're able to tell that, and how you feel about that? And then Valeria, if you can jump in and say what is the best approach for a business? How do people decide whether it should be lending or equity?
Yeah, sure. I mean, yes, it's equity crowdfunding, so you're giving away equity. Um, it all depends how much you give away, depends on what your valuation is and how much you're trying to raise, of course. You've got to have a realistic valuation. You've got to go, I mean, in the world of startups, there can be no hard and fast rules on valuation, and crowdfunding sites typically tend to have probably slightly higher deal or two investors. You sometimes don't know if it's a good or fair deal, or they might be trying to get a large amount of equity from you for and their value, they might drive you down on valuation. Where I quite liked the fact of the aspect of crowdfunding that you set the valuation, you set the terms of the investment, and that's it. They're fixed. They're out there. You know, it's sort of take it or leave it. It's not some negotiation where the person with all the money can, you know, put your arm up your back and like twist your arm and get a better deal for them. You know, it's this felt like a clearer cut sort of way of offering it. And then if people aren't interested, then there's a wide number of people looking at it. So yeah, I mean, we calibrate each round sensibly on sensible valuation, and therefore a sensible amount you're raising, which has got to be a credible plan for whatever you're proposing to deliver in that round. You can't sort of have something unrealistic. So you'll get, if on a public site like Crowdcube, you'll get sort of pressure tested from all sides in the discussion forums, and you get challenged on your valuation, the amount you're raising, your plan, everything. But you know, if it's in the way that's put together, you can usually give away reasonable amounts of equity. I think it's usually stated on the round how much is being given away. In the first round, I think we gave away something like 17% of equity. We raised 500,000 in 2017. We then raised 1.5 million in 2018, and gave away a similar amount again because the valuation was that much higher. And you know, there's more shares allotted, so that's diluted as you allot more shares. And I think typically that's the normal amount is up to 20% on a crowdfunding round, maybe a bit less.
And
you're more giving away effective it is investors.
And you're clearly quite comfortable with giving away equity. What are your thoughts on doing that?
Well, yeah, I mean,
it needs must.
Depends what kind of business. Yeah, it depends what kind of business you're building. If you're building a business that needs to scale and grow, like us, I mean, our business, it's been predicted that a unicorn business could emerge, and certainly a business in the hundreds of millions here. You know, that business will need capital to get to that point. You've got to raise capital to grow. So as long as the valuation is going to grow up, most people don't mind taking dilution if they know that the valuation can rapidly grow at the same time. If you're another sort of business where there isn't some big open-ended market opportunity, I'd consider if this was the right thing, because I think crowdfunding sites particularly work well for businesses where there's a high growth projection, because normally people are not investing for dividends, they're investing for equity to come on the journey with the business and to the exit point. You know, it's not about this is going to give you annual returns really on these sites. It's about these companies are part of a tech boom or revolution in a particular sector, and they're going to be very highly valued in a few years. And if you can provide them with the capital now, you can have the benefit of a huge ROI exit in potentially in a few years' time. And that's why those certain businesses suited to it, and certainly not really.
Yeah. Valerie, can I just bring you in this point? Can you just talk us round what businesses need to think about in terms of giving away equity, not giving away equity, in terms of how they decide where they're getting their funding from?
Yeah, absolutely. So I think some of the points that Matt mentioned are really crucial. So it all depends on the size and the nature of the business and where it is in its growth life cycle. So if you want to keep full control of your business, then some form of lending will be appropriate, such as peer-to-peer lending. But of course, as Matt mentioned, because lenders take on higher risk, they would want you to prove your ability to generate higher returns. So you need to be able to demonstrate the viability of your business. It cannot just be an idea. You should have some infrastructure in place, perhaps a prototype product, You should have performed initial market testing, and you should know the scope of your market. For lenders in general, you need to show good credit history, and the repayment schedules are less flexible. And inevitably, the more leverage you take on, the higher is your risk of default. So you need to think about whether you'll be able to generate the cash flows in the short to medium term um, to meet those repayment schedules. I think another very important factor is whether you can work independently. So, to what degree do you need access to the guidance and education from your founders? Do you need access to networks and potential clients and distributors? Do you need access to expert knowledge, market knowledge? Um, do you need to have access to someone that will be nurturing you in a way? That really is a determining factor. Um, I think one factor that is often overlooked within this is whether you need to access financing at all at this point. Because irrespective of the type of financing, whether it's debt or equity, there's a lot of pressure basically to deliver the returns that your fund provider expects. And this is particularly if you would be approaching angel investors. You need to make sure that you have devoted enough time to work on your business, the products, the services, so that you can really present your business model in the best possible light. Um, I think if you access external financing too early, that can actually kill your business because of the pressure. And I can give you an example. There's an example of this online study application Quizlet, which allows students to study via learning tools and games. And what this company did, it was eventually very successful because it raised $30 million late stage funding through VC in May 2020. Uh, Currently, it's valued at $1 billion. But this company actually took its time. It waited for 10 years until approaching external financing. So you really need to make sure that you've got your business model right, you've got the products, the services right, you can demonstrate the growth and the valuation. So I think the timing is really, really critical as well.
Thank you. That's really interesting. Matt, you mentioned a little bit about you have to do quite a lot of work talking to potential investors and backers. Can you talk me through, first of all, does that take up quite a lot of time? And also, do you feel the pressure to succeed? I mean, obviously you want to succeed, but the pressure on you to perform. Can you just talk us around the sort of mental approach you have to take to this and the practical approach?
Yes, sure. Yeah, it is time consuming crowdfunding. I'm in the middle of it right now for the fourth, fifth time. So constant calls and at the moment Zoom meetings and email conversations. Lots of people are throwing lots of questions at you all the time, and that's just part of it. And some people will take up a lot of time and they won't invest, and that's just part of it. And you have to just play the numbers game. You talk to enough people, keep putting the right message out. You get a certain amount of them investing. Pressure, yes. I mean, it does add pressure, I guess, but I think you're already, the way I felt was that you're already under pressure because you started this business, unless you're doing it as a side project or something. You know, I'm an entrepreneur. This is my fourth business. So when I exited my third business and launched Borrow a Boat, I'd put money in, and I was in that business already. I had put pressure on myself to succeed, and I felt someone coming in to help me was a good thing. And they're going to want results, but I want results, you know. So for me, it didn't really change anything about the way I was running the business. I just thought that these guys are going to help me, if anything. So, you know, I mean, I'd agree with the comments that, you know, you don't want to raise too early. I mean, in particular, raising debt, I think adds a different kind of pressure, because it adds financial pressure, because you've got, you know, the repayments will come on to you, the business, and add that stress of having to meet the repayments, you know, on top of maybe payroll and something else. Which one of the part of the beauty of equity is there is no repayment. So that's why particularly well suited to the startups as well. It's a way to get capital into the business with a minimum sort of burden on the business.
That's interesting. And also, Valeria was mentioning, and actually you just mentioned the word help. Have you found having angel investors on board, have they actually, apart from the cash, have they actually brought anything else in terms of help or advice, or have you asked them for help or advice? How important was that side to you?
Yeah, I mean, the angels are always usually quite interesting people. They're people who've done well in business or have had businesses and things. And there's lots of conversations with them, usually in the run up to them actually investing around the business, which is an extension of this, the investment discussion, you know, and quite often those conversations will continue after they've invested, because they've got ideas. Some of them want to be a bit more involved. Some have taken non-exec director positions at business. So it was a bit more ad hoc, I suppose, with the angels, just as and when, if you'd gone on well with them, pick up the phone to some of them, ask a bit of a few tips here and there. Whereas with the VC, so we went through a change in 2018 where the VC investor back to borrow a boat, and as part of that deal, took a seat on the board. We set up a board structure. For the first time, didn't really have a board before that. It was just me as the only director. And yeah, the dynamic changes a little bit at that point. We've got another couple of investors on the board, and then there's a board of accountability, which, yes, they are holding the business to account, and but they're actually ultimately there to support the business. They're ultimately there to guide and help, and at the end of the day, so if the business has a problem, the board is there to help solve it. You know, we're kind of in it together. So there's a few more brains around the table for different problems or ideas if the business needs to pivot or do something, you know. So, and there's much more a regular, structured engagement at that point.
Right.
Obviously, some coming earlier into the board, but we chose to do it at that point. Yeah.
And we've kind of talked about these alternative, newer ways of raising money, but can we just go back to, you know, the bank manager? Have you ever, at any stage of this business, you know, been to talk to the bank, or would you have even wanted to talk to them about getting a loan or an overdraft or whatever? And if so, what kind of response did you have, or did you not go down that route at all?
I talked to different lenders near the beginning, yeah, such as Funding Circle and other ones like that, peer-to-peer lenders that are offering them services at business events and things. But as I said, I found none of them could help us because we were too early for them all. You know, they all wanted you to be 2 years old.
Right.
And it's right, a certain business is might be the perfect option for a certain business which is 2 years old and may not have the big going for the massive growth. But for a tech startup which is going for huge growth, in a short period of time, that is sorts of options don't work as well. So no, we never really considered it for very long. Equity was always going to be less burden on the business financially, as we say, and bring more other minds and ideas and people, and bring capital in fast as well. Potentially at a large scale. I mean, we've raised over 3.5 million now. I don't think we could have borrowed that much very easily for this business at this stage. But yeah, I think later it will become something we'll look at more, actually. When we go past the main equity stages, we'll consider, we've been offered venture debt recently, and different debt options may become a better option for us as a mature business.
Thank you. Valerie, can we just bring you in here at this point? Does that tally with your thinking that bank loans and banks are off a later stage, or is there a role at all for them at early stage businesses?
Well, I think the attitude of banks has probably shifted a little bit. I mean, because of the 2008-9 financial crisis, I think banks became even more cautious, and they became even more stringent in terms of the requirements that they had. But I think within the context of the pandemic, what we've seen based on some statistics is that banks have been particularly willing to lend to businesses. I mean, according to a report published by EY, business lending grew by 14% in 2020, which is the highest level in 13 years. So I think because the 2008-9 financial crisis was because of banks themselves, whereas this pandemic is very different, banks are kind of more willing to help and support businesses. Having said that, I do think that Matt is right in the sense that they would still want you to show the credit history and the proven track record of cash flows. So the attitude is changing, but you still need to show some history. So probably 2 years of cash flows and growth and so on.
And what you said earlier, thank you. It's interesting. You know, we are obviously in the middle of a pandemic, and there's a tendency to think, oh, there's no money out there. You know, investors won't want to invest. But actually, I was looking at some figures, and private equity and VC funding is at some massive peak at the moment. There is loads of investors out there. Is that your understanding as well? Is there money out there to invest in the right sort of businesses? What's the sort of attitude in the investment market at the moment?
Yeah, absolutely. I think there is definitely money to invest. And there's certain types of businesses, obviously, that would be favored by the pandemic. So, for example, um, business, pharma and biotech has experienced the largest growth. Roughly 20% of venture capital investment in Europe in 2020 was within this space. Anything to do with remote enabling, so facilitating working from home or uh, food delivery or remote shopping has also been favored by VC investors. Um, there is one worrying trend, and it's the fact that typically what we've seen in 2020 is that VCs have been favoring what we call follow-on rounds of funding. So 93% of VC funding in Europe was on follow-on rounds. So that's where you've already established your name and you have the history. So the VCs and the angels feel kind of more confident in terms of investing in you. So it is a little bit more challenging for first-time capital seekers at the moment.
Okay, thank you. So we're getting to the end of our time here. We're almost out of time, but I'd just like to ask you both, if someone has a good business and you know they're at early stages, what are the sort of tips that you can offer that they can actually do right now? And it might be that they don't want to raise money instantly. It might be in a few months' time. Can you offer some thoughts on what they could be doing with their business to get it really kind of investment or lending ready, that it's going to look much more appealing to a lender or an investor? Valerie, can you just offer a couple of quick thoughts on that?
Yeah, I think you need to ask yourself two hard questions: whether your product or service will be needed in the post-COVID world, and whether you can build it in the most efficient way. If the answer to both is a confident yes, then you should prepare for in-depth due diligence by fund providers. In this pandemic, investors are really focusing on due diligence, and you will be scrutinized more closely. So you should really um, focus on making all your content instantly shareable and accessible for potential investors, making sure that your figures and projections, such as your monthly cash expenditures, how long you can survive before you run out of cash, what is the impact of coronavirus on your sales and your future plans. You really need to have that outlined and built within your documents. And another aspect, I think, is you need to work on maintaining or building relationships. And this is in all directions. So with customers and employees and investors. So remote pitching, it makes it harder for investors to build a relationship with the founders. You can't really read the founder and get a feeling for the person or the business model with the remote pitching. So it is ever more important to work on building your relationships with potential investors.
Thank you very much. And Matt, the final word to you. Can you just give a couple of top tips to what a business can do to do what you've done and be very successful in raising money?
To anyone starting out, yeah, I would say get into the market as soon as possible. I've seen a lot of people sometimes have an idea and they're spending a lot of time preparing it, preparing the business and talking to investors at that point. I'd say get into the market as soon as possible, spend the minimum amount maybe to get trading and get information from and feedback from your customers as soon as possible. Start gathering data as soon as possible on how people are reacting to the idea, what the average order values are, what the conversion rates are, what the feedback is, and try and get some of this key data that you can then show to investors. And if you do your research on the size of the market, you can put that together into a compelling proposition based on real engagement from customers rather than the hypothetical. So into the market, I would say.
Thank you very much indeed. Thank you to both of you and to indeed to our audience. It's been really interesting speaking to you both. Thank you very much, and Matt, best of luck with your business.
Thank you.
Good luck.
Thank you.
Thanks everyone. Cheers.
Bye bye.